Markets are quite volatile right now, and quite a few people are planning to stop their SIPs in mutual funds. But I feel that this decision is not right. Market by nature is volatile, and this is the time when markets are low, one should invest more and not stop their existing SIPs. Okay, not going into the debate and coming back to our topic. So, in today's video, we will do a detailed review of one not so popular mid-cap fund, that is Kotak Emerging Equity Fund, and check its performance using real data. And by the end of the video, we shall be able to decide whether we should continue our investment in this fund or switch to other fund. Hello everyone, I am Dhaval and welcome to my channel DIY Finance. To start with, we all know that Kotak Emerging Equity Fund is a good performing fund in its category, that is the mid-cap category. Here, we will be taking into consideration data of direct plans only. I have earlier done a detailed review of the same fund in April 2022. Link of the video is attached in the I button and in the description. So coming back to the video, firstly, let's look at the basic details like AUM, that is total asset under management, which is around 24,000 crores, which is a little bit on a higher side for a mid-cap fund, while the expense ratio is 0.49, that is less than 0.5% and quite low as compared to other schemes in the category. The benchmark index, that is the reference against which the scheme is compared, is Nifty Midcap 150. Now let's look at the sector-wise allocation. From the table, it is very clear that the fund is heavily invested in capital goods, followed by finance, materials, chemicals, consumer discretionaries. And when compared to its benchmark, its allocation is quite different. But the allocation is quite even between finance, materials, chemical, and consumer, which makes the fund quite diversified. Now let's look at the top holdings and portfolio allocation. Schaeffler India, Cummins India, SKF India, and Thermex are the main stocks of the capital goods sector, whereas Supreme Industries is the major contributor in material sector, and Persistent System is from the technology sector. Here also, the stock selection looks good. Now let's also check the portfolio allocation. On checking the portfolio allocation, it is evident that the mid-cap shares form around 74% of the portfolio, whereas large-cap shares form other 22% of the portfolio, and only 3% is allocated to small-cap shares. With the above allocation, the fund is able to provide a stable return with less risk, as generally large-cap stocks are considered stable and less volatile. There are in total 74 stocks in the portfolio, with top 10 stocks making 33% of the portfolio and top 3 sectors making around 41% of the portfolio. This type of allocation and number of stocks make the portfolio quite diversified and minimize the chance of concentration risk. As evident, the fund follows a growth style of investing, and it is a general perception that the growth stocks do not perform well in an overvalued market. Since last couple of years, the market were quite overvalued, and now that we are seeing a value and time correction in the market, we hope to see the growth stocks perform better. We will also try to correlate this theory in the return section. Before checking the returns of this fund, let's look at the fund managers. Mr. Pankaj Tibrewal has been managing the fund since January 2013, that is, since the inception of the fund, and that too very efficiently, and hope that he continues in future also. Here, this long-standing association of the fund manager with the same scheme is quite positive and an advantage for the scheme. Now let's look at the returns generated by this fund. Firstly, the trailing returns. On comparing the trailing returns for 6 months, 1 year, 3 year, 5 years, 7 years, and 10 years, it is able to beat its benchmark and category. May not be with much high margins, but the fund has been able to outperform for the entire period, which is quite good. Now let's check the calendar returns and see how the fund is consistent in its performance. Here we have the calendar returns from 2014 to 2022, that is 9 years, and the fund is able to beat its benchmark and category for 6 of these 9 years, which indicates that the fund is quite consistent in its performance. Now let's quickly look at the fund's performance for the year 2023. Here also, if you observe, the fund's performance has been better than its category and benchmark for most of the period in 2023, which is quite good for a fund and is expected from the fund. Now let's also check the rolling returns. Here we have rolling returns for the period 1 year, 3 year and 5 years. For 1 year period, the fund is able to beat its benchmark 88% of times, whereas for 3 years period, it is able to beat its benchmark 100%, that is all the times. And also for 5 years period, it is able to beat its benchmark 100% with no negative returns for the entire range. Hence, it can be concluded that for a longer investment horizon, the fund's performance is quite good and there is no evidence of negative returns if the holding period is 5 years and more, which is quite good for a fund. Now let's see how the fund performs on risk parameters. Here we compare the parameters with the benchmark index and the category average. First one, mean returns, that is the average return in a year, which is 24.7 and is more than both the category average and the benchmark. Here, higher the value is better. Second one, standard deviation, that is a tool to measure how much the returns have deviated away from the mean returns, which in this case is 24.19 and is less than the index but more than the category average. Here, lower the value is better. Third one, Sharpe ratio, that is a tool to measure risk-adjusted return, which is 0.87, which is more than the benchmark index and the category average. Here, higher the value is better. Fourth one, beta, that is the volatility of the scheme compared to the benchmark, which is 0.96, which is more than the category average. Here, lower the value is better. Fifth one, alpha, that is a tool that measures how much better the fund has performed compared to the category. Here, it is 0.92, which is more than the category average. Here, higher the value is better. Hence, it can be concluded that the fund is able to generate better returns than its benchmark and category, but with a higher standard deviation than the category. Now let's see the upside and downside capture ratios. The upside capture ratio is the measure of how the fund performed relative to the index during the period when the index rose. Here, the value is 101, which indicates that the fund outperformed 1% more than the index during the rise period. Here, higher the value is better and should generally be more than 100. The downside capture ratio is the measure of how the fund performed relative to the index during the period when the index has dropped. Here, the value is 86, which indicates that the fund declined 86% as compared to the index during the fall period. Here, lower the value is better. Now let's see the risk return graph. Here, on x-axis, we have standard deviation, whereas on y-axis, we have total returns. It is very evident from the graph that the fund has a better total returns value with more standard deviation as compared to the category average and benchmark, which indicates that the fund has been able to generate better returns with more volatility compared to its category and the benchmark. So now coming to the conclusion, what investors should do. But before concluding this video and suggest what investors should do, I request all of you that as you have watched the video till now, it seems that the topic is of your interest. Hence, I would request all of you to press the like button and also subscribe to my channel if you have not done till now to watch such interesting videos in future also. So coming back to the conclusion, what investors should do. Firstly, the existing investors. The fund's performance has been consistent and marginally better than the index. Hence, if you are content with the performance of the fund, you can continue your investment in this fund. But if you are looking for a higher return, maybe with a higher volatility, then you can look for other funds, which I would suggest in the coming section. Second, for the new investors, they can start new investment as it's a good and consistent performing fund. But keep in mind that its performance is only marginally better than the index. But if you are willing to take more risks, then there are midcap funds from Quant, Mirai, and SBI fund houses, which have better mean return values, but with a little more volatility into bracket risk. I would like to add that I have Kotak Emerging Equity Fund in my portfolio, and I am not planning to change the scheme till my next review. I will again try to review this fund after 6 to 7 months and check its performance, so stay tuned to my channel. To check my older videos, click the attached cards. Thank you.